Hello everybody, welcome back to what I'm calling Learning Forever. I'm Alex, and if you're new here, my goal is to break down complex topics and to make them both fun and understandable for everybody. Every week, I dive into lectures and key historical moments, giving us all a chance to learn together. On the last video, we covered deposit insurance, adverse selection, and some fundamentals on financial safety. Today, we're going to take a deep dive into the National Bank Act of 1863, a pivotal moment in U.S. history that will set the stage for our current banking system today. We'll explore how this act worked, why it mattered, and what came next, especially the rise of New York as a financial hub. This video will cover the lecture for October 31st, so if you missed it, this will cover mostly everything. As always, I hope you guys enjoy the video, and without getting distracted any further, let's get into it. So let's set the stage. It's the early 1860s, and the US is knee-deep in the Civil War. The government desperately needs funds to support the war effort, both on the battlefield and at home. The National Bank Act of 1863 was introduced as a way to create a unified, stable currency and fund the war at the same time. Before this, the American banking system was like the Wild West. Each state chartered its banks, which printed their own money, which was unregulated and often unreliable. As we know before, imagine traveling to New York, to Ohio, only to find out your cash isn't accepted because it's from an out-of-state bank. This was a nightmare for anybody trying to do business in this time. The act did a couple of big things for us. First, it introduced national banks, private banks that operated under federal regulations. If a bank wanted to issue money that would be accepted nationwide, it had to back that money with the federal bonds. Essentially, these banks were required to invest in government bonds as collateral to issue their currency, called national banknotes. This meant that if you held $1, you knew it had the same value wherever you went in the US, thanks to the government-backed system. The government cleverly used this structure to fund the war. Banks had to buy bonds, which put money directly into federal hands, giving them a secure funding stream for the war effort. Imagine every time you wanted to use cash, you had to donate to a cause. Except in this case, it wasn't optional. You had to support the war if you wanted to issue currency. In the end, it was a bit forceful, but it worked. The government stabilized the economy and ensured that the banks across the country followed the same rules, creating a standardized currency that gave the people more confidence in the money that they held. With the National Bank Act in place, we had two types of currency now, the national banknotes and the state-chartered banknotes. So what did we do with them? National banknotes were backed by government bonds and had to follow federal regulations. They were reliable. A VIP pass across the entire country, accepted anywhere. But there was the catch of the state chartered banks continuing to issue their own notes, which were the local currency. We know that these banknotes weren't backed by the government bonds, which made them less trustworthy. Let's try to put this in perspective. National banknotes were like a credit card of today, universally accepted and backed by an institution that you can trust. State banknotes, on the other hand, were more like store credits from small local shops. You could only use them in specific places, and the value of them was widely unpredictable. Some state banknotes were backed by assets that weren't always liquid or valuable. You might have a banknote technically backed by livestock. It was true chaos. So in 1865, Congress slapped a 10% tax on state banknotes to phase them out, pushing the state banks to either convert to the national system or stop using their currency altogether. So gradually, national banknotes took over, and the chaos of the state-issued money had finally faded away. Fast forward to the late 1800s, we see New York emerging as the financial center of the United States. By then, New York was roughly holding 60% of all reserves in the US banking system. This was largely due to the bustling economy on Wall Street and the city's growing reputation as a financial hub. Banks from all over the country sent their reserves to New York banks for safekeeping, which created a centralized pool of resources. But the centralization came with its own set of challenges. Seasonal demands, especially during harvest times, required banks in agricultural regions to withdraw cash to pay for crops. This led to major fluctuations in the reserve pool and affected the interest rates in New York's call loan market. where banks would lend short-term funds to brokers. For example, a bank might lend money to a broker who might needed some quick cash to buy some long-term assets, like stocks or real estate. But when those reserves were pulled from the harvest season, the call loan market would dry up, pushing these interest rates sky high. It was kind of like a pressure cooker, with no steady control. Any sudden demand for the cash could create a shortage, sparking financial instability. New York's reserve pool was both a blessing and a curse. It was a reliable resource, but also highly vulnerable to demand spikes. This lack of stability laid the groundwork for the need for a central bank act as a safety net. By the turn of the 20th century, the call for the central bank had grown loud. Without a central institution to act as a lender of last resort, banks had no backup plan during the crisis. If reserves ran low, they were left scrambling. Any disruption could lead to panic. And I will cover these panics in a future video. But right now we want to cover the concept of the lender of last resort, which is crucial in banking. It is a lifeline that a bank can rely on when reserves are low. A safety net that could prevent total collapse. Today, that lifeline is the Federal Reserve, as we have established. But in this time, there was no such institution. If banks needed cash quickly and couldn't get it, the entire money multiplier effect, the process which banks create money by lending deposits, could unravel, shrinking the money supply and slowing down the economy. The result? Fewer loans, less money circulating, higher unemployment, and overall economic downturn. The National Bank Act set up a strong foundation, but the cracks in the system revealed themselves. New York's Clearinghouse Association tried to act as a temporary safety net, but it just wasn't enough. Eventually, the financial system needed a centralized bank that could stabilize the economy in these times of crisis, which we know led to the creation to the Federal Reserve in 1913. So this will cover October 31st lecture in economic history. Thank you guys so much for tuning in to Learning Forever. I'm Alex, and I hope that you guys enjoyed diving into the origins of American banking. If you found this video helpful, please drop a like, comment, share, do anything you can to show me that you love these videos. It helps me keep bringing you these breakdowns every week. I would like to provide a huge shout out to all of my patrons supporting the channel. You're the reason that these videos keep coming. I will be back next week with more economic history. So make sure to check the link in the description down below to stay connected. I'll see you guys next time. Have a great day.